Today, I want to talk about an indicator that is rather common and often overlooked, the moving average. Like most indicators, if misused, will cause you to lose money and blow your trading account. But if you use it correctly, it will give you an edge in the market, not just for Forex, but in any market. So today, I will show you two high probability pullback strategies that work. These are pullback strategies, and I'm going to provide you with the specific things you need to watch out for. I will show you a neat little trick to avoid getting whipsawed in a ranging market as well, so be sure to watch this video till the end. Sounds good? Then as always, please hit that thumbs up button and subscribe to support the channel. A lot of resources go into creating these tutorial videos, so I would really appreciate if you could just support this channel. And if you wish to participate in our giveaway worth $37, then look for an emoji somewhere in this video. You can also find the full instructions in the pinned comment down below. Now, just in case you are new to trading, a moving average is simply the average price of an instrument for a period. So for this strategy, we will be using the 200-day exponential moving average, a moving average that places more weight on the recent price data. For this video, I want to focus on the strategy and not touch on how moving averages work. But I've previously uploaded a video about the different types of moving averages. So if you are totally new to trading, then do check out that video at the top right corner or at the end screen next. Now, a word of caution before I go into the strategy. These two strategies are pullback strategies, which means that the market has to be trending and the moving average has to be sloping up or down. This strategy doesn't work in a ranging market. So always pay close attention to the moving average slope before using this strategy. A lot of traders miss this pointer here and thus end up misusing the moving average. So as I go through the two strategies, I will keep reiterating this pointer so that it sticks in your mind. For the first strategy, we will be using the 200 period exponential moving average to determine the trend, and the 50 period exponential moving average to look for pullbacks. The 200 period exponential moving average provides a simple way to decide whether or not you should be buying or selling. Look at where the price is relative to the average. If the price is above, then you want to look for buying opportunities. And if the price is below, then you want to look for selling opportunities. It's that simple. Now, the 50 period exponential moving average, on the other hand, will tell you where you should be buying or selling. Often, newbie traders struggle with identifying key support and resistance levels to buy or sell at. So by using the 50 period exponential moving average as dynamic support and resistance, it makes it so much easier. By inputting the exponential moving average like this, two traders can look at the same chart and agree that this is the level that they want to buy or sell at. So essentially, we want to wait for a pullback to the 50 period exponential moving average. And when price hits the level, we want to watch for a pin bar or engulfing pattern. Again, I will reiterate that we have to look at the slope of the moving average. Both the 200 period and 50 period exponential moving average should be sloping upwards or downwards. So let me walk you through an example. Over here, price is above the 50 and 200 period exponential moving average. At a glance, we know that we want to look for buying opportunities while ignoring selling opportunities. When price pulls back to the 50 period exponential moving average, we wait for a price action candlestick pattern. Once we see it, we can enter the trade. Now here's a very important pointer, so pay close attention and keep watching. I chose this specific example to illustrate a point. In this example, the trade setup fails and results in a loss. That's okay, it's part and parcel of trading. Now, if you get stopped out on a setup, then price has to break this swing high before you can look for another setup. This rule alone will save you a lot of money, because if the price starts going to consolidation mode, then the price will fluctuate up and down the 50-period exponential moving average. And we don't want to be buying each time we see price bouncing off the moving average in a ranging market. Of course, the same applies for a bearish scenario, but I will not go into that in this video. Now recall what I mentioned earlier in this video. This is a pullback trading strategy. So we need price to be trending and the moving average to be sloping upwards. How do we ensure this? By making sure that the swing high is broken. This is a fundamental rule that most traders do not follow, and as a result they get whipsawed and claim that moving averages don't work. Now let me quickly show you a winning trade just so that you know how this first strategy works. Here we see that price is below the 50-period and 200-period exponential moving average. This means that we want to be selling. When price pulls back to the 50-period exponential moving average with a doji and engulfing bar, we can go ahead to take the trade. Notice that both moving averages are still sloping down when the trade was taken. This is the ideal setup. The entry, stop loss and take profit will look something like this. Now I won't go into trade management and placement of take profit target in this video. But if you need a hard and fast rule, then set your take profit to be 1.5 times of your stop loss. Which means to say that if your stop loss is 100 pips, then put in a take profit target of 150 pips. So let's move on to the second pullback trading strategy. For this strategy, we will only require the 200-period exponential moving average. And just like the previous strategy, we will be using the exponential moving average as dynamic support and resistance. Based on my experience, just using the 200-period exponential moving average on its own isn't a high probability strategy. Many rookie traders make the mistake of buying at the 200-period exponential moving average when the market trend is down. They have no concept of market structure and trend. So what often happens when the price hits the 200-period exponential moving average is that price has been trending down for quite some time. Because after all, the 200-period exponential moving average is usually quite some distance from the swing high or swing low. To counteract this scenario, we need to add in certain filters to help us find the highest probability setups. We need to watch for the market structure and trend to align. This concept is a little hard to explain, so I should show it to you instead. So right here, we see that price has just rallied and broken past the 200-period exponential moving average. So obviously, if price is above, then we want to be buying. Price pulls back to the 200-period exponential moving average, and notice that there is a confluence of market structure. And if you were to observe the swing highs and lows, you will also notice that the prior swing high has been broken. This is the first sign that the bearish trend is reversing and the bulls are stepping in. So this is how you put everything together. You have to align the market structure and trend together with the 200-period exponential moving average. You do not blindly trade every time the price hits the 200-period exponential moving average. You need to understand the market context. So let me show you another example to illustrate this. Over here, we have price staying above the 200-period exponential moving average. Thus, we want to focus on buying opportunities. Because this is an established trend and the 200 period exponential moving average is relatively far. We can expect that the market trend will be bearish when it retraces to the 200 period exponential moving average. This is normal, as what I explained previously. If we zoom in on the charts and look, price is indeed making a series of lower lows and lower highs as it retraces to the 200 period exponential moving average. Thus, in this case, you cannot just buy off the 200 period exponential moving average. We have to wait for the market trend to align. Specifically, we need to make sure that price makes a higher high instead of resuming its usual pattern of lower highs and lower lows. When price finally breaks the swing high and forms a higher high, we can then proceed to look for an entry when the market retraces to the market structure level. So notice how I combine market structure and trend seamlessly into my analysis. This is how you should perform your analysis. If you are still confused, then try to think of it as watching for a chart pattern at the 200 period exponential moving average. It could be a double top or bottom, head and shoulders, or inverted head and shoulders. Here's a quick drawing of what I mean. To sum up this video, I went through two high probability pullback strategies that you can use with the 200 period exponential moving average. The first involves using the 200 period exponential moving average to determine direction and a 50 period exponential moving average to enter your trade. The second involves aligning the market structure and market trend when the price bounces off the 200 period exponential moving average. Now remember that both of these strategies are pullback trading strategies. So the prerequisite is that price must be trending and the moving averages must be sloping upwards or downwards. As promised, I will leave a link to the different types of moving average videos at the end screen over here. Thanks for watching and make sure to subscribe to the channel if you got value.